Let's talk about a classic Wall Street puzzle. You've probably seen this happen. A huge company absolutely smashes its earnings report, beats all the expert predictions, and then its stock price falls off a cliff. So today, we're going to use Netflix as a case study to figure out what is really going on behind those numbers.
I mean, if you just looked at the headlines, Netflix knocked it out of the park. Revenue was up, profits were way up. But the market's reaction? It wasn't exactly a standing ovation. So what gives? Why the major disconnect?
It's like you're looking at two different stories, right? On one side, you've got the results, a total home run. On the other, the market's reaction, a complete strikeout. How can both of these things possibly be true at the same time? Okay, to solve this thing, we've got to start by looking at just how good those headline numbers really were. You know, the big, flashy figures that grab all the attention first. So Wall Street was expecting, what, 76 cents per share? And Netflix comes in with $1.23. Look, that's not just a beat. That is a massive outperformance. We're talking an 86% jump from this time last year. Incredible.
But if the numbers were so amazing, why did the stock take a nosedive? Well, because, as you see so often in finance, the headline almost never tells you the whole story. Tucked away inside that fantastic profit number was something that made savvy investors, well, pretty skeptical.
And here it is, the secret, right there in Netflix's own letter to its shareholders. A huge piece of that profit came from a one-time event, a $2.8 billion termination fee because a deal with Warner Bros. Fell apart. That's not money they made from selling more subscriptions, that's a fluke. And this brings us to a really important idea in finance, non-recurring income. Think of it like this. Finding a $100 bill on the street is awesome, right? But you can't build your monthly budget around the hope of finding another one. Investors do the exact same thing. They look right past these one-time windfalls to figure out the true, ongoing health of the business.
So the real skill for any investor is being able to separate that one-time noise from the signal of the core business. And it's actually not that hard. Let's do a quick tutorial on how the pros get this done.
It's a pretty straightforward process, really. First, you start with the big number they report, the net income. Second, you got to read the fine print to find any of those one-time items, like that big termination fee. Third, you just subtract that gain, and what you're left with, that's the recurring profit. And that's a much more honest look at how the business is actually performing day to day.
But here's the thing, even after you adjust that profit number, that still isn't the main reason the stock dropped. The real story, what Wall Street cares about more than anything, isn't what just happened, it's about what's going to happen next.
This is the perfect way to get into that mindset. An earnings report is basically a report card on the past 3 months. But a company's guidance, that's its forecast, its promise for the future. And for a growth stock like Netflix, the future is everything.
So how did Netflix promise for the future stack up? Well, the revenue guidance was fine, pretty much right in line with what everybody was expecting. But the operating margin, a super important measure of profitability, that was a different story. Netflix guided to 31.5%, when the market was really hoping for 32%. Now that might sound like a tiny miss, but that tiny miss is a very big deal. Why? Because a stock like Netflix is often what we call priced for perfection. Investors have already factored in flawless execution and huge growth. So the moment the company signals even a slight slowdown or just a little less profit than hoped, it shatters that whole perfect story, and the stock price has to adjust down to a new reality.
So we've got an inflated profit number and a slightly underwhelming outlook for the future. But professional investors, they're kind of like detectives, and they spotted a few other cautionary clues in the report.
First off, there's the valuation. Netflix's price-to-earnings ratio, which is basically a quick way to see how expensive a stock is, was over 42. Historically, its average is closer to 16. At that kind of price, good news just doesn't cut it. Investors are expecting absolutely spectacular.
And then you see this little data point. In the 3 months right before this report, company insiders, we're talking executives and directors, the people who know the company best, they sold over $138 million worth of their stock. And how much did they buy? Zero. Now, people sell for lots of reasons, but that kind of one-sided action can definitely be seen as a warning sign.
And finally, there's the world Netflix lives in. They even say it themselves. It's intensely competitive. They're not just fighting Disney anymore. They're fighting for your eyeballs against YouTube, TikTok, and video games. It's a nonstop war for our attention, and that puts constant pressure on growth.
Okay, so we've taken this whole Netflix report apart. What's the lesson here?
Let's boil all these clues down into a practical playbook that you can use the next time any company reports its earnings.
Here it is, your 5-point checklist. 1. Always look past the headline number. 2. Go find and adjust for any of those one-time, non-recurring items. 3. Focus on the future. Compare the company's guidance to what the market was expecting. 4. Check the valuation. Is the stock priced for perfection? And number 5, see what the insiders are doing.
So you see, the numbers themselves rarely tell the full story. It's the context, it's the expectations, and it's the promise of the future that really drives the market. So the next time you see an earnings report, don't just ask if the company beat the estimates. Ask yourself, what story are these numbers really telling?